All right. Welcome everybody to Midas Investing Live. Happy Sunday afternoon to everybody out there. Hope you guys had a good week. I know I have had a pretty good one. So right off the bat, I will mention that I did put out my advanced auto parts video this week on Friday. So if you haven't watched it already, definitely make sure you go out and check out the video. It's performing pretty good so far, given that it's just been a few days. Definitely had a lot of views for that one, and it seems like it's gotten a pretty good spike in some subscribers relatively to how fast they normally come on any given day. So if you're one of the newer viewers watching this either live on the replay, welcome to the live show. We do these once a week as well. Also, if you're watching live or on the replay, please like the stream. It's the best way that you can help make sure that we get lots of viewership and help get it pushed out to more viewers out there on YouTube. And if you haven't already subscribed to the channel, subscribe as well. That'd be really, really appreciated. That way you get notified whenever I put out videos like my advanced auto parts video or my other videos, which for the record, I'll bring this up, my Smith & Wesson video, the video that I put out 2 weeks ago. It's gotten a surprisingly low amount of views relative to some of my other videos in a relative similar amount of time frame. I almost feel like Google is basically not pushing it because it happens to be about guns or something like that. Maybe it's just that it's a less popular stock, but I mean, some of these other companies are not necessarily the most popular companies and it's performing well too. So very, very interesting on that one. Jeff, yo, Midas out with the fam. We'll have to watch replay. I'll share the AAP vid on Reddit. I hope it drives some more viewers. Thank you very much, Jeff. I definitely appreciate that. Yeah, and you know, shares would also be super, super appreciated alongside those likes and subscribes. So yeah, just like Jeff, if you can share the content, that would be really, really appreciated as well. But yeah, no worries, Jeff. You have a good day. We'll see how the show goes here today. It's mostly just going to be kind of a relaxed live stream today, I think. So no worries on that. I don't have too much necessarily super prepared to talk about today. We're just going to kind of talk a little bit about a few random details here and there. Bring up a few things from some past live streams and covering a few little, I guess you could say, gaps in some things that we've discussed in the past. And kind of talking about other things that I'm looking forward to trying to do in the future. And also I'm here kind of trying to get more ideas for things in the future. So if people come in here today, if you're watching now, or if you're kind of like coming in and watching a few minutes behind, we're definitely looking for more tickers as suggestions. We're going to be spending more time today looking at tickers if people are here to give them. Also, I'm really trying to look in particular, not just for random companies to look at, but we're really going to be trying to think more in terms of some of the themes that we've been looking at. In particular, the need for grid electrification. If you watch my advanced auto parts video, we talked a lot about the inadequate electricity grid issues that we have in terms of how people are trying to expand the EV space. So we're definitely looking for companies in terms of that. Also, in the medical space, I'm definitely looking for more medical technology companies similar to InMode. There's a few other companies that are kind of on the back burner that people have talked about a lot in this space that I'm already kind of looking to look at. In particular, companies like Hologic, as well as Medtronic, and a few others like that. As well as other companies that are also fit in with kind of the grid electrification, but like backing up things like that, emergency supplies and things like that for when there are power losses, things that kind of fit along with the Generac mode. So if you have suggestions of companies that kind of fit into some themes that are similar in that path. Oh, also another theme I would mention, the advanced auto parts is kind of meant to fit into the theme of people kind of getting ahead of themselves in terms of the transformation to EV space. I imagine there's other companies that where we can probably identify ways in which the market is discounting the need for certain services like the auto part space over the next decade or two, on the assumption that those kinds of vehicles are going to be outmoded. So if the other companies like that, I did see, for example, some of the comments on the advanced auto parts video, there was a few other suggestions of other companies like Genuine Auto Parts, and there was one or two others that people were saying, well, whoa, why don't you take a look at this one, take a look at that one. And while I don't necessarily want to look at every auto part company out there, other similarly framed kind of theses around the long-term mindset around certain companies, I am interested in things like that. So suggestions that people have that kind of fit into those modes, definitely looking for. Let's flip over back to the portfolio dashboard, we'll talk about a little bit of the stuff that happened in the portfolio this week. We did do some changes in the portfolio, nothing super major. In terms of returns, it was kind of a flattish week, as you can kind of see here. Pretty flat for the indices as well. So not like that I was necessarily missing out too much in that regard, but we certainly weren't making up the lost ground either. But more on that in the coming weeks and months, I guess, as that either continues or improves. But I did get rid of Intel this week. I finally decided to sell out of Intel for a loss, for a pretty significant loss. So definitely not a very satisfactory holding over the long run, especially considering we had held that one for quite some time on a weighted basis of the shares held close to 2 years, I believe it was around there. So if people had seen that in the portfolio for a long time, if you've been watching me for a long time, I've had Intel for a long time. I had much more bullish valuations around it in previous years, partially due to a failure in my previous models, my valuation models prior to the more distribution-based models that I've been using recently. I frankly had a larger mistake in the discount rate assumptions that I was using. I was specifically often relying on specifically just whatever the risk-free rate was in determining the amount of the growth in the terminal year. However, I think that was a larger mistake because lots of companies are going to grow slower than the economy in the terminal year, especially more mature companies and companies that are not at a competitive advantage. Like, for example, maybe companies like Intel. So there's this mistake applied to a few other of the larger losses that I took on some other companies. Situations such as Turtle Beach, this would apply to. You might be able to say this somewhat applied to Alibaba, although that I think had larger to do with revenue growth rates. And I would say revenue growth rates had to do with each of those issues. But the point is these problems compound on themselves. If you're massively under discounting the terminal value, then any growth rates you used before you got to that terminal value, it's only going to, exponentially affect the mistake, effectively speaking. So the point is my more recent models that are built around distributions of larger sets of outcomes allow for larger sets of outcomes also in those terminal assumptions. And so I think it's much more conservative valuations these days, but also much more accurate. So we've also had a pretty strong growth in a few of the other positions. This kind of chart right down here that shows the cumulative total returns, including dividends, for each of my positions as they currently stand. So you can get an idea of just how much gains I'm riding on for each of the positions. For a long time, Meta was the only one that was candlestick in green here, which generally signifies more than 25% up in total returns. So that was kind of like the big winner for a long time. And obviously my put option strategy, which is kind of just expected to take losses unless the market's making a dive, was generally the big loser here. Intel itself was a big loser for some period of time. Inhibit was a big loser, but has been slowly moving back up. Now only 20% down, only 20% down. Wow. But the point is other players in the portfolio have started to do rather well. FG were up almost 40%, which is pretty awesome in total returns, and then FNF up over almost 33%, which we've held FNF for quite a long period of time. So the gains on that one has kind of just ebbed and flowed a little bit over the period. What was that last thing you said there, Jeff? Forgot one more thing. Added AAP, CVS, FMBL this week. Just some tickers for the log. Cheers again, man. Great week. FMBL. Yeah, I'm not sure I'm familiar with that one. I may have to take a look at that one here in a little bit, perhaps. But yeah, good ads. I definitely, like I said, added some AAP before I put the video out. I'm trying to go kind of slow with adding to it because, as I kind of like showed in the video, it's not that I necessarily have some super love of the AAP brand in particular. It's kind of a larger strategic mindset of like how I see that industry and their place within it that makes me interested in them. So I am trying to build up a position with them, but I'm definitely trying to kind of go slow about it because I feel like we could see some volatility in that one. But who knows? Maybe I'll be wrong about that one and it'll race up ahead of me like some of the other smaller players that have had. But that's part of the kind of larger strategy, as I've been talking about over the last several weeks. I've been trying to kind of build up a larger pool of smaller positions so that at any given day, one of them might be taking that dip. And so I actually have a few better options in terms of longer term models for companies that I can add to on any given week. So maybe this week it'll be AAP I add to, maybe it'll be Jackson that I add to, situations like that, basically. So yeah, moving on from that, also we have MPW. MPW has really started to come up pretty strongly. This one was a little bit of a kind of short-term mean reversion valuation play on the assumption that, frankly, the negativity surrounding the stock was just way too overdone. and there was a lot of negative reports surrounding it as well. And I believed that a lot of the negativity and things pointed out in those reports were just unlikely to pan out in the short run, even though they weren't necessarily in some super great financial position themselves. But they also had a very, very large dividend yield. I can't remember where it currently is right now. Let me kind of go find out. That it's currently 11.2% as where it's currently trading. On my cost basis, I think it's closer to 13%. But the point is it's a very, very nice yield of a REIT. And so I was kind of looking at this as a good opportunity in a very, very high yielding REIT in the short run to take that play. I thought it might take closer to like 6 months to a year before this one started to get the capital appreciation pan out. And it's actually started to come back up pretty significantly in the short run. Not super far up there. We're not looking to necessarily get out of it today. I have actually already trimmed it in tiny amounts as it's moved up here, because it was never intended to be a very long-term position. It was definitely meant to be more of a short-term, just mean reversion play, for better or for worse, with the yield acting as kind of my buffer, just in case it turned into a longer-term situation than I might have desired. But the point is I'm probably going to keep trimming as it keeps moving up. Basically, whenever it gets a little bit over 1%, I kind of just trim it back down to 1%. So we'll probably keep doing that generally indefinitely. And then maybe at some point or another, we'll actually get out of it if it comes back up to the levels at which I thought that it was likely to mean revert to. But either way, the point is it's pretty nice to actually have some companies making more significant gains rather than just kind of like smaller gains that we had been seeing for any companies like Smith&Wesson recently, as well as Schwab. We had some more significant gains on, but they kind of pulled back a little bit more recently. In mode, we also had some more significant gains on, but I actually did make the relatively tough decision to buy up a little bit on the very, very tiny initial position that I made, because if there was going to be any company out of the several companies that I bought recently that I was going to maybe FOMO a little bit into at a higher price, it was going to be in mode, because I saw the higher opportunity there over the long run. And just in case it never did come back down, I needed to add a little bit more. It still is an incredibly tiny position in the portfolio, still less than 1%. But the point is I had a little bit more. But ideally, we would definitely like to make it a much larger position if it did come back down. And who knows, maybe we'll get that opportunity at some point in the short to midterm. Hard to say. So one other thing I kind of wanted to bring up, I was kind of already talking a little bit about some of the comments that came on the advanced auto parts video, but unfortunately there was one comment on there that was a little bit sad to read, which was of some gentleman. I don't know if he's ever going to end up watching this live stream, but I'm not going to call you out too directly, but there was one gentleman on there that basically said that he put pretty much his whole investment portfolio in advanced auto parts at around the price of 80, and he's feeling a lot of distress surrounding his position. So I definitely wanted to kind of like comment about that, not to like call out that individual or say, oh yeah, all the big mistakes you made or something like that, but to really kind of like point out to people to be very, very careful about portfolio allocation. When you put a bunch of money in a single position, you really are basically putting a lot of risk into the assumption that there's nothing just acutely going to go wrong on a business level. There's all sorts of like weird, quirky things that can happen that has nothing to do with your analysis in a company, has nothing to do with any of the projections you've made about the revenues of the future or the operating margins. It might just have to do with some stupid action that some executive made that creates a big lawsuit for your company, or something like that. It's like there's all sorts of weird, quirky things that can happen that can be totally outside your ability to predict. So that's one of the reasons I think diversification is super important. I know a lot of smaller investors and retail investors in general, some of them really get the diversification idea, but then a lot of them really, really don't want to diversify that much because they listen to some of the better investors, the bigger investors, the like Charlie Mungers of the world, who talk about diversification and stuff like that. And while I think diversification is totally a valid other end of the scale to talk about, but the point is I think you really ought to make sure that you're diversified in such a way that you're not necessarily thinking about any one individual company too much. It's like it shouldn't necessarily be the only focus of your mind what one individual company is doing, because you're not in that company, you're not running that company. So it's so much outside your power to actually do much about it, unless you're an actual significant shareholder, and then maybe you can ring up the CEO or something like that. But I have a lot of confidence in like my positions in Smith and Wesson, which is why it was closer to like 10% of my portfolio for a while. It's actually now down to like 7-8%. And that's not because I sold shares. That's actually because I've added a bunch of money in capital, new capital added to my portfolio over the last several months. So like I've actually made significant enough deposits in my portfolio that we've made some of my positions smaller. But like Smith and Wesson was closer to 10% of my portfolio for a while there. And that was before it even moved up in capital appreciation terms a little bit. FG is, you know, sitting here at like 5 to 6% of my portfolio. But you know, I would maybe make that go up to 10%. Point is I don't know. I think once positions get over 10%, it really starts to be a real concern. It's something that you really ought to be thinking about. It's like, what would happen if you woke up tomorrow and that stock was down 50%? Because that's the thing, is like an individual company, you know, some freak thing could happen. It could be down 50% in a day. You should sort of think about that term. So it's like, what if your whole portfolio was down 5% in a day? Because that's what it would be. If you had 10% in a stock and it was down 50% a day, that would be like your whole portfolio going down 5% in a day. So it's like, I think you should consider portfolio allocation in terms almost like that, in terms of thinking of like, if this stock went down 50% today, that would make my total portfolio go down this much today. And if your portfolio was down this much and the whole market was not down at all, at what point does that start to bother you? Like there are days where I'm down 1%, maybe even close to 2% on like some of the worst days. My portfolio might be down 2% while the whole market's flat. Like those are days that I actually have in my portfolio. And those are, you know, not super comfortable days, but whatever, it's just 2% in my mind. I'm like, whatever, I can also make that back in a day too, right? But the point is how much are you willing to stomach? And so you should never size your position so much that in a freak occurrence where potentially something outside your happening makes the company go down 50%, what would the effect on your whole portfolio be? And how would that drive your decision making? So like I said, the gentleman out there that is super long 100% advanced auto parts, I wish you the best. Obviously my valuation says that your price of 80 is pretty all right. But point is, I can't tell you when it's going to maybe go up there. I feel confident over advanced auto parts over the long run based off the model that I built. But if it stayed where it was right now for another year or two, that wouldn't shock me. If it went down to 60, below 60 into the 50s for a year, that also wouldn't shock me. Would it shock you with your cost basis at 80? I don't know. That's for you to decide. I've been significantly down on some positions and held it through. As you all saw, I was holding Intel there for a very long time, and then I eventually sold it. So obviously I eventually gave up on Intel, but my thesis sort of changed around it. But other positions I've been majorly down. I was majorly down on Smith& Wesson. I was down like 30-35% at the worst point in Smith& Wesson, and we're up on Smith& Wesson now. We're not up 35% though. So, you know, it was like we've waded through more pain to get to a smaller amount of gain as of where it currently stands today. Obviously, I think it'll get more over time. But the point is how much pain are you willing to sit through? So best of luck to you, Mr. Gentleman, that's 100% advanced auto parts. But obviously, you know, you made a mistake by allocating that much. Whether or not you can you know, how you choose to accept the mistake is up to you. Maybe waiting through the pain and getting those good returns in the end is how you will accept the pain. And if that's the case, well, then you might end up being like, well, this was a good move in the end. I don't know. Especially if some of the higher ends of my estimate end up being true, then maybe this is going to be awesome for you. But if it's a long wait, maybe you have to get out of some of that position and diversify. I don't know. Maybe taking a loss on half of your position so that you can diversify into other things is better than psychologically sitting through the pain of 100% all the way through. Even if it goes up in the end, it's like maybe it's worse. Maybe it's better to take a short-term loss to be able to sleep better at night. So I just kind of want to talk about that because that comment was definitely a harsh thing to read. Somebody's talking about how stressed they were to be 100% on that position, even though, like I said, my value was obviously very optimistic relative to what they had, but it's still very, very difficult. So one other comment that was on the advanced auto parts video that I wanted to bring up, and kind of like a totally different direction, is somebody brought up Amazon and e-commerce. and I didn't bring up Amazon e-commerce at all in my video. So I thought I would kind of like talk about that a little bit. I took a day before kind of responding to their comment because I kind of wanted to look into it a little bit. I was like, ooh, wow, that is something that I kind of did overlook a little bit. There has been a pretty significant explosion in auto parts sales online. And I didn't really take that into account when building my model for advanced auto parts. Now, I will say that that's not necessarily going to affect my valuation too much. So that's not like a huge problem for the model. And that's because of the way that the revenues are grouped off by the data sets that I was using from Aswath to Motoron. The automotive retail groups included a very specific set of companies and the revenues from those companies. It didn't split it off by like segments from other companies, so it wasn't including specific auto revenues from Amazon. Amazon's revenues was in a different industry grouping set, right? So the point is, while e-commerce or Amazon or e-commerce in general, whatever, it was taking up a pretty significant chunk of the auto parts sales. The only way that that's going to affect the model is by decreasing the expected growth rates of that automotive industry grouping over time, right? That's the only way that that's really going to affect it. And the model that I built had really low growth rates for that industry. I was basically assuming that it was going to remain flat in like a lot of the situations and be like maybe 1 or 2% per year in like the more bullish case scenarios. I think it was up to like 3% on the top case, and it was like flat in the base case and like -2% in the bear case, something like that. It was not very huge revenue growth rates for the industry as a whole, based off of the model that I built. So the point is I feel like I was conservative enough that it kind of already accounted for this. And that was based off of the slowing growth rates over the past 5 to 10 years that I had observed in that data set, which were affected by these numbers. So it's like, it was kind of already baked in. I didn't explicitly mention the e-commerce thing, but there was basically those assumptions were kind of already baked in. But I did go find this article here from Hedges and Company, which is, you know, take that for granted. It's just this this report from this company here. But they have their they have a little discussion of the industry growth rate of e-commerce auto parts out to 2030. And I was looking at their report that they're talking about, and like kind of how they talk about the historic numbers in data and how it's split off from it. Looking at kind of like the historic ranges over time. They're currently, as of 2021 and 2022, around 15 to 16%. As a ratio of the e-commerce sales relative to all of the auto part sales. And that seems to be relatively consistent. And the projections they're making out to 2030 seems to believe that that ratio is going to remain relatively consistent. So the point is this kind of third-party report seems to believe that the ratio between auto parts e-commerce and total auto parts is going to remain consistent over the next 5 to 10 years. And my model basically assumes that the changing growth rate is going to remain consistent from the past 5 to 10 years over the next 5 to 10 years. And so I think those assumptions at the end of the day are consistent with each other. You can go look for this article if you'd like. I thought it was pretty interesting. I found it. You can find it just by typing like auto parts e-commerce 2030 Hedges and Company. You can find it that way. Also, one of the detail that it mentioned in here is that there was a bit of a change up in the last couple of years to the relative growth rates that seems to coincide with a slowdown in the ability to get parts because of the supply issues that we've been going through. So, and the way that they talk about that makes me believe, oh, here it is. Yeah. Many e-commerce parts and accessory retailers are having supply chain difficulties through 2022 that plays a significant role in the overall growth rate for online revenue. A major problem right now in our industry is inventory availability, not consumer demand. It kind of sounded very, very similar to some of the other things I was reading in some of the other reports from S&P Global, which makes me believe that there's going to be a bit of a mean reversion. Like people have been shifting to online sourcing for their parts, partially because it's been a little bit easier when supply constraints have been difficult for the last year or two. So once supply constraints start to alleviate a little bit, they'll go towards the places where the inventory is most readily available rather than waiting 1 to 2 days for the e-commerce shipments. It's like, yes, Amazon fulfillment is fast, but we can get it today at some places, right? So it's like, why not just go for that? So the point is, I feel fine enough with the projections as I built it. This doesn't, with that comment, it definitely made me think for a second. You know, I was like, oh wow, I better double check that, make sure that I didn't super miss this by not talking about this at all in my video. But at the end of the day, I feel fine enough with it, having looked into this a little bit. I think that the assumptions that I put into my video basically already align well enough with this concept, basically speaking. So anyway, that's with that. Like I said, it was just a couple things I wanted to talk about in relation to the video that I put out. Definitely looks like not too many people here today, which sucks considering, like I said, today was kind of like the more ideal day for people to be coming to give me their suggestions of all sorts or whatever. This was kind of like almost suggestion day. I did miss the one comment there. Pavel, I saw you, and it was just kind of like a hello, so I didn't quite respond because I was kind of in mid speech there. But thank you. You're thanking me for your research. I thank you for your thanks. Nice to meet you from the Czech Republic. Always nice to hear from my international viewers. It's always fun. It's always fun hearing who's hearing you from where. We've had some people from Germany. We've had some people from the Czech Republic recently. People from Brazil. People from Israel. People from all over the place. It's pretty fun. Pretty fun meeting random people from all over the world. But anyway, so let's move on. One of the other things I kind of wanted to mention, as I was saying, just kind of filling in, talking about some of the things we talked about in previous lives, things that I've thought about a little bit more, worked on a little bit more, and wanted to kind of bring back up again. So a few weeks or months ago, I had done a large presentation on the oil markets, including showing off my revenue, or not my model for oil price projections over the next decade or so. Here, one second, just gonna moving myself a little bit. But anyway, so the point is I fine-tuned my model a little bit more, the regression model that I had made. I had previously showed this regression model, which I had talked about as being based primarily around city urbanization rates, because that was like one of the only factors that I was able to find where the rate of change in said factor over one decade had a high effect, statistically effective effect on the price changes in oil in the next decade. Because this isn't just a thing about trying to find something that correlates well with oil. It's not that hard to find things that correlate well with oil today. The tricky part is finding something that has seemingly an impact on oil prices over the next decade. That's the difficult part, is finding something that has a long-term forward effect on the commodity price. But as I had talked about in that live stream, I had said that city urbanization rates was like one factor that the one factor that I seemed to be able to get the strongest corollary factor to. Now I tuned this model a little bit more and played around with some data a little bit more, and I managed to get a few other factors to work better, which is good, just by basically playing with some of the basings of the data itself. So like specific variants of like how it's actually measuring each of these measures. Like, there's a few ways you can kind of play with the numbers a little bit to tweak it. As long as it's consistent across each of the measures, it's fine. But the point is there's a few optionalities with it. So I played with the numbers a little bit more, and I managed to get a few other economic factors to work alongside the city urbanization rate. Specifically, what I managed to get was population growth over time, which is really, really good to be able to get that one to work, because there's government projections of where the population is going to go worldwide over the next decade. So therefore you can make a projection in oil prices based off of that factor individually, not just by combining it with other factors as well. So population growth, as well as city urbanization rate, as well as then I also managed to get M2 per capita growth over time. M2 specifically being US dollar M2, and the per capita being of the global population. And that might sound a little weird to use US dollar money supply base for the global population, but you have to keep in mind that the US dollar is the reserve currency and is the financial instrument through which over 75% of all international transactions are based. So it has a pretty significant factor to it. In fact, I tried using a more global money supply factor, and it didn't get the same type of explanatory power. The USD M2 had more effect on this. But the point is per capita. So we effectively, if you kind of think of it about, it's like how many people are there, where are the people living, and how much money per person is there in the global economy. Those three factors, which kind of all work well together because they're non-overlapping in that way. And I managed to get them all to sort of coincide together into a model that was slightly more effective than the previous model I had showed in that live stream. Because I don't know if people had remembered, I had showed the model with error bars of 2 standard errors outside of the range around it. Now I didn't have it colored to show the difference between 1 standard error and 2 standard errors, which I have here. So it looks a little bit different. But the point is in the previous model, I had 3 points outside of the 2 standard error range. And in this particular model, we actually only ended up with 1 point outside of that range. And that 1 point's also in 2020, which was, you know, some of the weirdest, most flukish events in oil prices ever. So you could almost easily maybe try to explain away that using that particular number right there. But the point is, so we managed to actually improve the statistical reliance of the model pretty significantly by only having 1 point outside the range. That's actually the acceptable failure rate of the two standard error range in order to say that the model has a normal level of predictability. And with a normal level of predictability, that means that we can actually say something about what's inside one standard error range as well. That means that we should expect at least 50% of all outcomes within one standard error range. And in fact, we do find more than 50%. It's like it's closer to 2/3 or 70% or so within that range, which is useful because that means that 10 years forward, we can therefore make the same sort of prediction. We can say that we would expect about 50% of oil prices to fall within this range of $109 per barrel to possibly $41 per barrel. Pavel, could you a little bit explain why you sold Intel? I'm still in basically flat now, but still think Pat Gelsinger makes good changes. Sure. I'll talk about it a little bit. It's definitely a little bit of a complicated discussion to a certain extent, and it's not necessarily that I think Intel is like, you know, garbage company or something and headed for trash. I think it's reasonably fair valued. Well, it's a little bit overvalued, I think, based off of my assumptions, but there's plenty of ways you could assume it to be fair value with a little bit more optimistic assumptions than what I'm using. And I tend to be a little bit more conservative, to be honest, when it comes to a lot of things. I also generally agree that Pat Gelsinger is making some pretty good changes as well. So I wouldn't necessarily get on anybody's case for wanting to continue to hold, especially if you're flat on it where it's currently at. So I mean, that would be pretty good for you. I myself was pretty significantly down on Intel, so my pricing was just bad from the first place. I would have had to wait many years in order to get back to the appropriate valuation, unless there was going to basically be a huge multiple re-rating, which I wasn't going to assume or rely on that to be happening in order to make my returns. I rely on fundamentals to get my returns, not on the market to give me some super special multiple rating. But yeah, so the point is, there's the reason partially why I wanted to get out of Intel in particular is that, like, yeah, it is a little bit overvalued by my estimate, but and like I said, I am probably being a little bit conservative there, but it also just feels like there's still a lot of uphill battles for Intel to fight. I think Pat Gelsinger is on the right track and he's definitely making the right moves. However, the previous managements have already put Intel so far behind their competitors that it feels to me like they're going to have to spend the whole next decade just catching up. And even in terms of catching up, we're talking about just catching up to like a level at which they can really compete, not even like actually being ahead again. I feel like it almost would take like 2 decades for them to actually get to the same level of being ahead again that they were previously, assuming they could even do it. You know, that assumes that that's even possible. And that's partially, my assumptions of that partially has to do with having done listened to a lot of podcasts and a lot of like technicians talking about like Moore's law and concepts like that. And obviously Moore's law is kind of broken down in recent years, but similar learning curve scaling processes and how that affects the ability to compete with the next players. Intel is incredibly behind their competition, and they haven't lost all of their ground in like the server space in particular, which is still one of the larger cash cows for them, but that's largely just because of how long it takes so many companies to switch over from one platform to another platform. So it's not like the PC cycle where there's like maybe every 5 years or so you're going to see people wanting to rebuild their PCs or something. It's like that itself is like a 10, 15 maybe even 20-year cycle for people to start replacing whole server racks because of just how integrated all of that tends to be. So there's a lot of people that maybe are looking to hop ship from Intel in terms of the server space, and they've already lost space in some of the other areas. So it's like I just feel almost like Intel is starting from scratch, basically, is kind of like my issue with them. And the thing is, like, I'm not, they're a little bit complicated. They're a little bit complicated of products. The technology itself. I'm not a semiconductor technician or something. I'm not an engineer or anything like that. I'm a finance guy. So I've, in recent months, in the last like this year in general, I've really tried to change up my game a lot by focusing more on companies that I can understand better. And Intel is one of the companies that I felt like I just
couldn't understand as well, just because I couldn't understand them as well. I can understand them from a consumer perspective. I am a consumer of their products, and that's the way in which I understand lots of companies, is by as a consumer. Like, for example, I could maybe say similar things about Meta. It's like I don't understand anything about coding or things like that, but I am a consumer of their products, and I feel like the consumption of Meta's platform gives you more information about how their business is going to be successful and the competitive advantages of that business than, say, like Intel does. Intel, as a consumer of their products, I don't feel like I know that much about Intel's products. Although I can tell you, as a consumer of their products, that people don't think of their products as high quality anymore. Yeah, it's one of these things where it's like they had a very strong moat of sorts, and they've allowed it to deteriorate. And so I I don't really feel super confident holding them as like a growth company, as a company that's starting almost like from scratch as like a new company. It's like they have an old name, but they're practically starting over in terms of like building up their technology, or at least that's kind of the way I feel about it. So like I said, I wouldn't begrudge other people who have their own reasons for holding it. It's not like I'm like, oh my gosh, this company's going down or anything like that. Even though, yes, I do think it's a little overvalued, but I still have like 8.8% expected returns over the next decade, which is not bad, right? It's not terrible. It's not amazing either, but it's not terrible. It's not like I think that they're going to, not like if you held this for the long run, I think you'd get some pretty decent returns, especially if you were buying dips and stuff like that, assuming that they performed fundamentally and whatnot. But the point is I'm looking for companies where I have more disproportionate upside. Where my uncertainties are to the upside. I want my uncertainties to be more about like how much market share they actually theoretically could take, or how could they price those products that I don't really fully understand how much money people will pay for. And those types of features are things that apply to companies like Smith&Wesson, like F&G, like AAP, like InMode, companies that I've been buying more recently. So that's kind of, I guess, my thoughts and feelings on Intel. I will say this, it's like I almost breathed a sigh of relief once I sold. And I sold for a loss, like I said. So I took a loss on Intel and I breathed a sigh of relief. And that's always a sign, right? It's like, yeah, man, you didn't want that in your portfolio. I clearly did not feel comfortable with it. I was just like, you know what? I don't really know what's going on here. Doesn't mean they won't do well. It just means that I don't feel like I understand how they'll do well necessarily. They just might do well, and it's not like I feel like I get it. I also see Intel as a hedge for China Taiwan tension. Yeah, and I somewhat held it. I mean, it wasn't like the reason why I was buying it necessarily, but I saw that as a quote unquote kind of option value to it as well, to a certain extent. But I'm just not so sure how great I consider that's one of the other things. I also don't really like companies that are reliant on subsidies. So that, which gets into like the competitive advantages things about it. It's like, so the CHIPS Act, they're getting funneled a whole bunch of money to build chip factories and whatnot, which a lot of people might look at that as being super bullish. It's like, oh yeah, they're getting all this money and all these tax benefits and stuff like that. And it's like, that might help the cash flows in some ways, but I think it very, very heavily damages the competitive advantage of them because they're not fighting for it. They're not actually doing it in the capitalist market. They're basically just being handed money. They're being told that they're the winners by the government. The government's picking the winners, and then that's what's happening. So it's like, I think that type of stuff typically erodes your competitive advantage over time. That's admittedly partially just my own ideological mindset. I tend to be one of the most like pro free market capitalist type people you'll ever meet. So I'm usually the type of guy that says, yes, get rid of all corporate subsidies, get rid of regulations, get rid of all that stuff, and make the companies fight to the death. That's my mindset on it. So if Intel is ever going to become a phoenix that rises from the ashes, in my opinion, it's because they're going to have to cut and fight tooth and nail to get there, not because the government's going to hand them $10 billion to build a factory or something like that. I almost look at that as like negative for them. But the point is, I bring that up after you brought up the Taiwan situation, because I think that's kind of like how a lot of people look at it. It's like, oh, Intel's sort of just like the government's favorite backup for this situation. It's like, I don't know. I don't like that. It just doesn't sound super good to me. Okay, thanks. By the way, if you want to know more about chips, probably not. There's a very good book, Chip War, about the whole industry. I actually read it very recently. And you could almost say that finishing that book is one of the things that convinced me to sell Intel. Uh, not gonna lie. I listened to the audiobook literally just in the last 2 months. Very, very good book. Yes. And, I mean, yeah, it taught me a lot about the history. Like I said, it's like, I know a lot of the history of the industry. I understand stuff like that. It's like the technology itself, it's like, I'm not an engineer. I don't know the technical details of it. So it's hard for me to like read a report about the technology and immediately understand like why this chip is going to be the next killer thing. That's kind of what I mean by that. But yes, Chip War, very, very good book. Anybody who's out there that is much more interested in investing in the chip space, and honestly, even if you're not investing in the chip space, I highly recommend people read that book. Just because chips are so vital to our situation right now, and in a political sense, like even if you're just, like I said, maybe you just want to understand the US Taiwan situation a little bit more, you could read that book for that reason too. That would be a very good thing. But that book also covers some of the other companies as well, like ASML. If you want to understand more about ASML, that book covers them as well too. And like, I'm very interested in ASML as well, but I also don't think I understand their technology as well. But at least I feel like I understand their competitive advantage a little bit more. And that's partially just because I understand what they have that other people don't have. But if some other companies started to come along that also did and built similar type stuff in similar quality level as ASML, it would then become very difficult for me to maybe decide which one is truly better, So it's like things like that, where it's like right now I could say, oh yes, ASML, that would be a great company to invest in. Not given its valuation though. Its valuation seems to be incredibly overvalued. I do have a basic DCF of them already. But the point is, if you were to get them at a good price, their fundamentals clearly seem like they're going to be amazing for the next decade at least. It clearly seems like they're going to have a competitive advantage for the next decade at least. But I don't know. After a decade passes, maybe there's ASML 2, whatever the next one is. And then maybe you have to decide between the two, and it's hard to decide whether or not ASML is going to remain the king, or maybe ASML 2 is going to take over, which is sort of like the situation that happened with Intel and AMD, right? It's like, I was hopping on Intel when it was dropping a little bit like a rock, when AMD was, kind of rising up from the ashes a little bit. And I was kind of looking at it like, well, Intel has so much strength. They have so much competitive strength. They have so much server market share. There's no way that AMD is really going to actually take a dent into that. And it's like, well, well, that, hard to say. Yeah, ASML is really expensive, but a very fascinating company. So worth paying attention to it at least. So let's see. Got a little bit on the sidetrack there to talk about Intel, which was a good discussion though. I was very happy to talk about it. So very happy to take the question. Like I said, I sold out of the position, so it's fair enough to give a thorough explanation of like, why did I sell out of it? Like what happened there? Especially since I held it for so long, right? I was clearly holding the bag for so long. But that's the thing, is like, I think it was also part of my mistakes there is thesis creep. This is a perfect situation to talk about that. It's like a lot of investors suggest that when you invest in a company, that maybe you should write down somewhere your reasons for why you invest in a company. And admittedly, I don't really do too much of that. I make my videos, I guess you could say, but even the videos are often more about like valuation. They're not necessarily about like why a company is in my portfolio necessarily. I have my reasons for why companies are in my portfolio, but even so, I don't necessarily keep like a journal of it. Some people do keep investment journals, so to speak. But the point is if you're not careful about it, then the reason why you're investing in a company might change over time. You might start investing it for one reason, and then that reason starts to erode, starts to become bad, but you're like, oh, well, I'll hold on to it for this reason. I'll keep holding on to this reason. And I did a lot of that with Intel. I did a lot of that where I was just like, okay, yeah, well, they're really starting to do poorly in this regard, but I'll hold on for this reason. Okay, yeah, well, they're still doing really bad, but now they have a new CEO, so maybe I'll hold on for that reason. Okay, yeah, they cut the dividend, but that was actually a really good move, and well, it was actually a good move, so I'm not arguing with that. But the point is yeah, you can find new reasons for why you'll keep holding on to something rather than just get rid of it. So like I said, not super confident in my model for Intel. Feels like they have a huge upstream fight. My thesis had crept over time, and I felt like there are other things I can put my money into. Why not instead put more money into the companies where I feel like I have been building a more robust model, a more thorough thesis for why I think it's going to do better over the future. So that's just kind of my mindset on that. But yeah, so coming back over to the oil thing, I was talking about my oil projections a little bit when we got off on that chat. But like I said, I was totally happy to do that diversion. So we haven't had too much chat here today anyway, so which is kind of funny because like I had somewhat set this live more aside for more chat questions. I often have like a little bit of a presentation talk, and then there wasn't. It seems like everyone's maybe just a little bit more busy today, but so it's nice to have you here, Pavel. As I said, I don't believe I had seen you in the chat before, so nice to have you along. I don't know if maybe you're one of the newer subs from over the last few days. But yeah, so with my oil projections, as I had also shown with this, while I do have a lot more higher confidence now in the 1 standard error range as a good predictive range for 10 years from now for oil prices, I will say that one thing about this is that with the adjustments to the model, including the other factors, it actually did widen the range a bit. So while this range is actually more statistically viable, it is actually a bit wider in general. Like even up to the second error range now goes up to $143 per barrel, and it actually goes all the way down to like $7 a barrel, which is kind of funny. It's like that doesn't really make much sense. So the 1 error range, it's good that it's more statistically reliable because it's actually now the range where things will start to make a little bit more sense. So we would expect 50% of outcomes 10 years from now to be between $41 a barrel and $109 a barrel. The expected value being about $75 a barrel. Now, I had also included lots of estimates from various other outlets like the International Energy Agency, the IMF, the World Bank, the NEB, McKinsey Institute, Deloitte and Touche, a variety of other oil estimates, and some of them based off of different years. And then I kind of made forward projections to make them equated with the 2032 number. So I have a variety of numbers based off of that. And then likewise, I had made a distribution of outcomes by essentially taking those differences. I have my regression outcomes. I have the estimates from the third parties. And then I have more outcomes based off of current and historic trends, and then outcomes based off of momentum and fundamental estimates. And then I split the outcomes 25% between each of them, and then built the distribution of the outcomes. So this is kind of what my distribution of forward oil prices for 10 years from now look like. It's a little bit different than, like I said, it was previously, but for the most part, it's kind of generally in the sort of same range. I think the weighted average number came down a little bit, but yeah. So my assumptions for oil being about $79 a barrel 10 years from now, which, like I said, I had also talked in that live stream about a lot of the screenings I had done of oil companies. In kind of relation to this, we had done a whole lot of screening of oil companies to try to identify companies that were most underpriced relative to oil, but also most underpriced relative to their own qualitative factors. And then we were trying to identify some of the best companies to maybe value and invest in based off of that, which had given me the results of a few companies in particular, which let me come back over to my value dashboard. We had Baytex Energy, as well as Parex Resources, as well as Cord Energy. So those were the 3 that came up to being basically the 3 most underpriced oil companies or energy companies in general relative to each other, their industry and oil prices in general. And then like I said, I made some basic valuations. 2 of them looked like they were somewhat undervalued. 1 of them not so much. And then I started looking a little bit more closely into Baytex, which I'm not sure. I might do a full video on Baytex, maybe. I kind of want to, but at the same time, it's a bit complicated. And I do tend to try to lean more towards, I guess you could say, companies that will be easier to make a more robust model for. It's like when I'm trying to think about companies that I want to make videos for, it's kind of a combination between how undervalued is it, like how good of an opportunity is it actually as an investment, is one factor I try to take into account. How good of a video will it do? Like how interested are viewers likely to be in this company? Like, is this a company that's likely to get lots of clicks? Maybe it's dived a lot recently. Maybe it's gone up a lot recently. Maybe it had a dividend cut recently. I don't know. For whatever reason, are people likely to click on it? That's one factor I take into account. And then the third factor I generally take into account when I'm deciding videos is how easy will it be to model the revenues? And easy is not necessarily the right word. It's more like, how thorough do I think I can do a good job of? Like that's the thing, is I'm trying to build good models. Like everything about the valuations relies on having a good understanding of the fundamentals. So I try to take that into account. It's like how complicated of a company is. As I was just talking about with Intel, it's like Intel I think of as a kind of complicated company to understand to a certain extent. And so yeah, it kind of comes down to that. But yeah, energy companies, I don't think of them as very easy companies either. Energy companies are a bit complicated. While I am trying to take a look at some energy companies, doesn't mean I'm necessarily going to make a full video for them, because yeah, I might decide that it's a little more complicated to bother for instead. Greg, hi, I just subscribed today after watching your video on AAP. Have you been following PBR? No, I haven't really been following PBR too closely. Let me actually pull that up. I'll pull it over here too. PBR? Are you talking about which one? The Petrolia Brasileiro? Is this the one you're talking about? I'm pretty sure I've heard of this company before. This is Brazilian, right? Petrobras? I'm not 100% sure if I'm looking at the right one. Petrobras? Okay. Yeah, I haven't really been following it. I think I've looked at this one once or twice in the past. Yeah, because like, you know, it's a pretty major Brazilian company. So which I've looked at Brazil companies a little bit here and there. It's definitely an economy worth paying attention to. Let's see. They're like kind of an oil major in general, right? Is that what they do? Am I remembering correctly? Explores, produces, and sells oil and gas in Brazil internationally. The company operates through exploration. But yeah, so they're basically like an integrated oil major, but in Brazil. That's what I was remembering in general. There's a lot of refining, transportation, marketing. Yeah, I haven't looked at them super closely, but I will say, like, the screens that I was just talking about for the oil companies, it was a very limited set of economies that I was searching across for the companies. So I definitely wasn't including Brazilian companies. It's worth noting. So this could be a good one, and it wasn't one that I was looking at. Is basically the point I was making. I was kind of trying to screen it down to a relatively manageable list when I was doing that screening process. So I had basically only included like 4 or 5 countries, not including Brazil. But yeah, so I don't know, maybe let me take a look at some of the numbers for it. I'll take a quick look right now. We'll take a look at the valuation first off. Of course, they're gonna have some negative years in here, which is gonna make it annoying, but we'll try to zoom in a little bit here. Yeah, so in the more recent time frame, we have like a normalized PE of around 10, EV to EBIT around 4 to 5. We kind of come back before the 2020 time frame. It comes into more of like also still in the range of 10 for the PE, 7 to 8 for the EV to EBIT. So that's maybe more normal for the EV to EBIT kind of range. Pop back to before the whatever issue they had there in 2015, 2016. It gets us to kind of like 13 for the EV to EBIT. So it's interesting that that's now higher. Still around a 10 for the EPE. So a remarkably consistent PE ratio whenever it's in at least a normal range of around 10, which is kind of nice. So you might be able to say 10 is pretty normal, but it's also worth noting that's with somewhat lower interest rates globally speaking. But it's worth noting that Brazil itself has a little bit less of that factor. Brazil has had higher interest rates during that time frame due to their inflation levels. So actually we could probably leave those multiples alone. But yeah, so I don't know, a PE of 10 might be a pretty normal PE to assume for them. EBIT around 8, and then we were just looking at their most recent numbers. It's more like 4 or 5, 3 4s. So based off of just multiples, you could easily perhaps see a doubling, but that doesn't take into other factors into account. Let's take a look at some of the well, actually, let's take a look at their estimates first. Expected huge drop off this year, probably, which is, you know, pretty typical for a lot of the oil companies. And then somewhat of a leveling off next year, a little bit more of a decline, but much less decline. And then they're expected to sort of level off there. At that point, we could probably assume growth at the rate of inflation. Let's then come over to the financials, take a look at the ratios. Look at gross margins and EBIT margins, and we'll zoom it back. Take a look at 10 years. interesting to see a very consistent uptrend in the margins rather than just kind of an ebb and flow in it, or a more consistent level here and then a spike up in the last 2 or 3 years, which is more typical of what we've been seeing in a lot of people's kind of atypical margin range. This kind of seems to suggest that maybe they were doing some structural changes, maybe spinning off certain subsidiaries or some segments or something. I don't know, I'd have to look closely to figure out exactly what's going on here, but this is kind of interesting that we have this kind of consistent uptrend in EBIT margins that is being backed up by the gross margin. See, it's like things like, it'd be one thing if it was just EBIT margins, it would already be interesting enough. But the fact that gross margins are doing it, that's kind of interesting. Kind of interesting, a little bit strange. Come down here, asset turnover versus return on assets. Asset turnover relatively low, which is pretty typical for a lot of natural resources. You get kind of higher margins but low asset turnover. Asset turnover spiking up in the more recent period, but nothing too crazy to spike up, kind of just like in typical range of the ebb and flow of what you expect. Return on assets also spiking up, but it was kind of weak prior to that. Very, very weak. Look at these low single digits return on assets, but that's not atypical for natural resource companies. You do often see low returns on assets or return on capitals that then spike up during the good years. But the idea point is that you're hoping that it's at least close to their cost of capital, closer to that, like, 8 to 10 range or something during the worst years. And then it spikes up higher during the better years. Like, this is where you want it to be during the good years, sort of, but this is still kind of low for the low years. But it is on return on asset numbers, which is a little bit of a flip on the return on capital number. You can kind of go back and forth on which ones to use. I prefer a return on capital number, but I prefer to calculate it myself. So the point is, if I'm not calculating it myself, I usually just rely on a return on asset number to be safe. It's kind of and then I just assume that it would be higher if I calculate it. Oh, hey, Jeff's back. Welcome. We got through a bunch of stuff, had a little bit of chat on some stuff. I'm sure you'll maybe enjoy the discussion I had about the Intel stuff. I think because we were talking a little bit about Intel last week. I think, Jeff, I can't remember what you said about it, but I'm pretty sure you might have said something, or somebody else said something that made me bring it up. But I did sell out of Intel this week, as I was kind of talking about a little bit. I don't know if you caught that point, but Pavel there in the chat was asking me to give kind of like a little dive into why so. So we did a little, I don't know how long I talked about it, but 10 to 15 minutes, I think, basically about Intel. Yeah, congrats for ditching that. Yeah. I was, as I said to Pavel, I literally felt relieved after I sold it. I sold it for a loss. It's like, if you lose money and you feel relieved afterwards, that means it doesn't belong in your portfolio. All right. It's like that means it doesn't belong in your portfolio for one reason or another. Feel like two of your special situations just mooned, BKI and ATVI. Yeah. Oh, and by the way, another one, ATVI, you had asked last week why I didn't sell out of ATVI. I did sell out of ATVI this week. So I did decide to get out of it. I was, you had made your comments about it. I was talking to some of the other members in the Discord that were in it with me as well, and decided to take it on that one. I'm still holding on BKI, but the same people I was discussing that with for ATVI, we've definitely kind of gone back and forth on the BKI one now too. So who knows? Maybe we'll take profits with it. Yeah, it's one of these things where it's like on the ATVI one. I know I had previously said, I was like, look, the reward has gone down because it's gone up so much, but the risk came down a lot too because the issue had disappeared. However, there is other risks, because now we have to wait a long period of time, and now it's more of like, I consider a time risk. It's like, do I really want to wait the time in order to get the small amount of reward? And I decided for ATVI, since it could be finished in a day or two, but it also could get dragged out for like another month or two because of some of the complications in that issue. So I decided to just be like, you know what, fine, let's get out on ATVI. But BKI, I'm still holding on. We'll see what's up with that, but we're watching it every day. What did I think of the CVS, AAP, FMBL, TFC positions? I didn't give too much comments to it, other than I had mentioned that I wasn't sure which one FMBL was, and that I was probably gonna look at it later, which maybe we'll look at it right now, because I'm pretty much done looking at this one for the most part. Only other factor I wanted to look at on this one was, I was gonna look at the liabilities real quick. Let's take a look at this. Which, if you didn't catch this, we're looking at Petrobras, the oil major in Brazil. Which looks cheap, and it might just be cheap just because it's Brazilian, that might be the case, but it is complicated too. So it's one of these things where it's like, It's another oil major, but it's one of the oil majors I didn't look at. I didn't screen. So it's possible that this one's worth looking at. These are some higher liability levels I'm seeing right here. That's for sure. It looks like they've improved it a little bit recently, but maybe bouncing back too. I don't know. I would definitely prefer to see this under 50%. I would say this is the first part I'm finding that's making me less enthused about this. Which would also maybe explain some of the cheapness too, because high levels of liabilities affects your cost of capitals, and that's going to affect the multiples you're going to trade at. So they could be cheap because they're Brazilian, and they could be cheap because they have high debt, and they could be cheap because both combined. That wouldn't surprise me too. I know, Greg, you had said crazy dividends. Yeah, that's pretty typical for a lot of those companies. They do tend to pay out the vast majority of their cash flows in dividends. A lot of international natural resource companies. Says here 119% payout ratio, but it's also worth noting that payout ratio should be done more on a cash flow basis, and this is probably more of a GAAP basis, so it's probably okay. Dividend yield, that says 81%. That's fascinating. I'm going to assume that that's probably not going to be a forward number. That might be because of a larger special dividend being paid on the quarter, and it might have already declined in price relatively. I'd have kind of an assumption there. Maybe not. But yeah, I don't know. Fascinating on that. But that's a worrying sign. That's a worrying sign. You know, people should be, concerned. It's like you don't get dividends like that for free. It's numbers like that exist because it's trying to balance some other issue out for. Chat popping. Hey, what's up, Scott? Everyone, all the normals showing up late in the party today, I guess. Were you taking a nap or taking a shower today? Is it your turn? Playing with the kids in your garden, out in the garden somewhere. But yeah, so let me pull up that another one, FMBL. I didn't say too much about the CVS one. I have looked at CVS in the past. I haven't looked at it recently with my more recently put together models, so maybe it would look better now. But to be honest, I'm not super big on the CVS, because partially I don't like I sort of like the pharmacy space because of its needs products, but at the same time, and it's the needs products that kind of relates into some of the discretionary products, like the fact that they have like makeup right there with the pharmacy products at the CVS's. So there's aspects to that business model that I really like, but it's such a low margin business, and they tend to have a huge amount of debt. And so I just don't really like the combination between those two factors, generally speaking. But like I said, it's been a while since I looked at them. I did look at WBA and CVS both in the past, and those were kind of my thoughts on both of them, generally speaking. So I don't know, maybe if I looked at them a little bit more closely recently, I would like them a bit more. But just there's some aspects to the business model I like, but then certain structural parts of it that I don't like. So this one, FMBL, is this the one? This is the one you were talking about? I have the right one. Let's see here. Provides various Schwab2, join the Discord. Yeah, he said he doesn't have the Discord, I believe, in the past. So yeah. Although Greg, if you're still listening, maybe you should join the Discord. Anybody who's watching live on the replay, it'd be really helpful if you would like the stream. Please like the stream. Help us get more likes. It helps to attract more viewers to the channel. Subscribe if you're not already. Join the free Discord. The link is in the description below. Also the pinned comment in the chat. Join the Discord to be part of the daily discussions we have, what's going on in our portfolios, as he was just talking about there. We talk about the various arbitrage opportunities or other positions we're talking about. Sometimes we're just sharing some memes or examples of our portfolio pies, analysis of other people and stuff like that. So come be part of the discussions there. It is free to join, so come be part of the group. And also, as I had kind of mentioned at the start, if you haven't already watched my advanced auto parts video, go and watch that, like that, share that as well. And if you haven't watched my Smith & Wesson video, go watch that one as well. What's going on here? Only 86 views on Smith & Wesson when we get in 2 weeks, when we get 220 views on advanced auto parts in 2 days. What's going on there? Kind of feels like Google doesn't want me talking about guns or something. 400 before that, 300 before that, 200 before that, 86. What's going on there? And it's not like it's not likes. I'll say this, it has a really high like ratio. So those of you who watched that video seem to like it, but for some reason, there's just not that many people clicking on it. But hey, they'll click on it once it decides to pop to $30 a share. So yeah, y'all will be regretting it then. That's all I'm saying. So whatever. Coming back to FMBL. Provides various banking products and services to individuals, professionals, and small to medium-sized businesses in Los Angeles, Orange, and Santa Barbara counties. Ugh, not super huge on like very, very geographically isolated models. That's one thing I'll say right off the bat. Just California. Offers checking savings, Christmas club savings, health savings, money market, investment accounts, demand and time deposits, certificates of deposit, retirement plans. So they do a pretty wide gamut of typical banking services. Just a very small regional bank in California. Let's see what's their valuation like. CVS is paying down on 69 billion debt from the Aetna acquisition, paid down 24 billion in 4 years. Yeah, that's pretty good progress. Great share repurchase program, bought 3.5 billion in dollars in 2022. Got some recently. For CVS, here's my thesis. It's a management turnaround, stopping acquisitions, paying down debt majorly, and going to use proceeds to do buybacks. Looks like you guys are in agreement there. Yeah. You guys basically just had the same thought at the same time, practically. All right. Very nice. Very nice. Yeah, I mean, like I said, maybe I need to take another look at it because it was in my older model that I had last looked at those companies. So it definitely has been some time. It hasn't been in my more distribution-based model. So yeah, looking at the PE ratio for this one over at least since 2014, we get an average of about a 12. Obviously, with interest rate changes on that, that might get us down to maybe more like a 10 if we were looking at more like an adjusted basis. So with a PE, maybe assumed for a PE of around 10, we're looking currently at around 7.5. So that's definitely seeming kind of cheap, at least compared to itself. Let's go maybe take a look at some of the other financial ratios. Return on equity, we'll take a look at that, which is pretty much one of the key measures for banks in general. See, at least this is kind of around maybe the kind of cost of equity level that you would expect. It's still a little bit low, but it's a little bit better than that other example I was talking about, although this is a financial versus a natural resource, but still sort of the same concept. Financial companies tend to have pretty weak returns on capital or returns on equity until they have good years for the most part. Or they have weak returns on capital, and then with enough leverage, they'll get good returns on equity. That might be the situation, depending on their situation there. Oh yeah, it's a financial, so it's not gonna have a lot of the same normal ratios over here, unfortunately. Taking a look at their EBIT margin. Well, not EBIT margin, net income margin, my bad. Net income margin's around 30% though. That's pretty decent. Not a lot of variability within it too, so that's pretty decent. Damn. Yeah, I'm definitely concerned about commercial real estate in California as well, Greg. So it's like one of the things where it's like, I don't know that I would want to focus. Like, obviously regional banks are regional, so that's just how it is for them. But I would maybe be avoiding Californian ones, and maybe that's my bias. Maybe there's some good opportunities there for that exact reason. So I don't know, but not as big on that. They trade like 100 shares a day and are extremely expensive on a per share basis. Low vol OTC. Oh, they're dividend king. Okay, interesting. Positives are slowly decreasing. Yeah. Yeah, I don't know. Could be a good opportunity. Definitely, like I said, definitely doesn't look super expensive, but definitely doesn't look like super cheap like a Jackson or something either necessarily. So what's another one? Should we take a look at CVS? Maybe take a look at it. I mean, you guys have kind of already talked about the numbers a little bit, so I kind of feel like I don't even need to look at them too much. We kind of already. I guess I didn't look at the valuation either, but may as well. Yeah. Oh yeah, yes. I thought I mentioned it in the video. Yeah, I started a small position before I put the video out. Yeah. Looking to add to it. Yes. Starting slow. That was one of the other sections that you missed. I kind of made there was a unfortunate poor gentleman who commented on the video saying that he basically put his whole portfolio in AAP. at a price of $80 per share. And he was talking about how concerned he was with that. So I did talk about diversification and the importance of diversification a little bit earlier, and was talking about that a little bit. But yeah, very, very excited about the AAP, but going slow at it, not allocating hard to it. Definitely taking my time about it. Definitely not putting the bank into it necessarily. But yeah, let's take a look. Take a look at CVS, maybe WBA at the same time a little bit. So average multiple over this 10 frame of 10 years, we get an average of about 13 for PE, about 11 for EV to EBIT. You can see it's definitely kind of decreasing over time. Probably as they were putting on a lot of that debt levels, because debt levels tend to have a pretty huge effect on multiples. Nice to see a WBA CVS commercial. Yeah, we'll take a look at that. Oh yeah. Jeff's backing me up on Reddit. He may not be on the Discord, but he's apparently sharing my stuff on Reddit, which is nice because I've got like no presence there. I do have a Reddit and I do post my links there, but I don't really use Reddit much. So that's the thing. It's like it's difficult for me to build a presence on a platform that I don't really use too much of, right? So it's like I try to share them as many locations as I can and try to have like things set up to auto share it or whatever if I can. But yeah, if I don't use a platform, it's very difficult. So it's like I gotta find some of you guys that are on some of the other platforms that can kind of be my proxy or my agent of sorts to be over there. But yeah, so looking at CVS, you definitely see it's a little up there. Let's put WBA up on the same time so we can kind of look at them simultaneously. Come on, there we go. We'll take a look at kind of one multiple at a time as well. Yeah, so taking a look at just the PE ratios, they have very similar PE ratios as you can see here. Pretty interesting. I do know that I'm pretty sure they have somewhat similar debt levels. I'm pretty sure CVS has a little bit lower debt levels than WBA, if I'm remembering correctly. So that's a little bit interesting that you wouldn't maybe see WBA be a little bit cheaper for that reason. But again, maybe I'm off on that assumption. Then maybe we take a look at the EBIT, which kind of adjusts for the debt levels and interest, but though it's usually kind of implied in the other multiples. Then we do see a little bit more of a divergence. And then we actually see WBA being traded higher, which is interesting. So do I have that in reverse? Do I have that in reverse maybe or something? Maybe I do. I don't know. Yeah, okay, this is what I thought I remembered. Yeah, I thought I remembered them being kind of in this range. 50 to 70 was kind of what I thought I remembered for them. Yeah. Okay, yeah, so they actually have more close. I thought I remembered WBA being like over 100%. So that's why I had that impression. Like I thought CVS was like in the 50 to 75 range, and then WBA was like 75 to 125 or something. I thought I remembered that. Okay, so yeah, they have a little bit. WBA has a little bit less than I remembered. That's kind of good for them, I guess. Which definitely explains that yes, they have basically the same multiple. So it's like same industry, similar capital structure. You're going to get basically the same multiple for the most part. Other than a little bit of a divergence in the WBA for the EV to EBIT, which is interesting. I'm curious to see why they have a multiple like that. Maybe it has to do with the interest costs or maybe taxes. I don't know. Maybe there's an explanation there, but I mean, because that's EBIT, so that's where the issue is, generally speaking, the difference there. But kind of curious. How about the dividends? What are their situations on in the dividends? Interesting. So a huge divergence there as well. And this is kind of in the opposite direction, which is kind of fascinating because we were seeing that WBA was trading more expensive. Usually if you have a higher dividend yield, you have a lower multiple because you're paying out large amounts of cash flow, which means the amount of cash flow that's being retained for growth is going to be relatively low. So there's going to be relatively low growth rates. So that's the general rule of thumb when it comes to multiples and payout ratios. So the fact that you're seeing a higher dividend yield, which implies lower price, against a higher multiple for WBA, which implies a higher price. So what's going on there? Did WBA have like a huge drop in earnings that's expected to recover? Maybe, I don't know. I'm trying to think of what would explain the two of those, but that's kind of interesting. Let's come back over to the, actually let's take a look at estimates. CVS's estimates for this year. So they're getting about 8%, then -2%, then 5%. If we flip over to WBA, I think WBA seriously disappoints more than Intel. Having listened to some of the other shareholders, that's definitely the vibe I've gotten to a certain extent. Yeah. Like it feels like CVS is like it's like the meme of Squidward watching SpongeBob and Patrick from outside the window, and it's like WBA watching CVS play outside or something. That's kind of what it looks like to me. So WBA seems to have some better growth rate assumptions, at least over the next few years, or better is a strong word, because they have a lower growth rate assumption for this year, like almost half as much, but then they don't have a negative growth rate for the year after that. So it's like on the combination of the 3 years, it looks like it's more growth in general. I'm not sure what's going on with that. Am I a long-term investor? Yes, sir. Yes, sir, I am. Or at least, you know, in spirit and in thesis, I'm a long-term investor, but I will certainly buy and sell in and out of something when it is over or undervalued, no matter how long it took it to get there, generally speaking. But when I buy into things, I, for the most part, buy things with a 10-year time horizon for my assumptions. But I gave that caveat though, because on average, I tend to hold things for like a year, typically. It's like I hold some things for like 2 to 3 years, and then I hold other things for a few months. But that's because my thesis changed, or it went up too fast, or something like that, you know. But yes, I categorize myself as a long-term investor. So the entire healthcare sector is kind of in shambles. If you remember my pitch on Cigna, maybe CVS falling related to this too, since they bought Aetna, that would make sense. That would make sense. It's definitely kind of been the whole space definitely has been kind of getting this, because like you know, a lot of these companies are basically assuming, or a lot of the investors in these companies all seem to know or expect some sort of level of disruption. Like obviously there was like that whole thing from a few years back, like the Berkshire and Amazon were like trying to team up to come up with some new pharmacy system or something like that, that fell apart or whatever. So there's been other companies that have definitely been kind of like looking into this space and basically being like, how can we get in on the action? Which is interesting considering it's like honestly such a low margin business. Interesting that so many people are wanting to get in on that action or something, but is what it is. We're gonna fix this problem. Yeah, exactly. It's like, thanks guys. And like, you know, Bezos and Buffett are smart and brilliant entrepreneurial geniuses, but to think that you're going to solve one of the biggest problems in our economy is kind of funny to a certain extent. So let's take a look at margins between these two. Yeah. So WBA margins significantly lower. These are the EBIT margins. So this is just like SG&A and restructuring costs, probably, that's primarily driving a lot of this crap right here. And gross margins as well, probably. In fact, yeah, let's throw the gross margins up there. Interesting. So WBA actually had stronger margins, gross margins in general, although that strength has been severely diminished over the last several years. And not just with WBA coming down, you can see CVS has actually kind of come back up a little bit. They were coming down for a while, but then they kind of tipped back up towards the levels that they were at previously. So CVS has over the whole 10 years been sort of flat in terms of the gross margins, whereas WBA has collapsed really in actual terms. I mean, it's only a downward move of about 8% in gross margins, but that's like 30% of all of their gross margins. They only had 30% to begin with, you know. So it's like that's pretty interesting, especially since it's kind of moving on the contrary to the line there. It's like they had higher gross margins, but then they ended up with a lower EBIT margins regardless of that. Even when they had the higher gross margins, they had lower EBIT margins. So it's like, yeah, CVS just looks to be like a way more profitable business structure, which is interesting because like, you know, other than the Aetna acquisition, it's like what structurally do they have that's so different there? And like that only happened, you know, was it 2019 that happened? I think that was 2019, right? Maybe it was 2018. I can't remember. One of those years. It was like here that happened. So it doesn't really explain the earlier part of the history. So it's kind of interesting. Yeah, I don't know. Maybe it could be interesting to look at one of them. Maybe we could take a look at CVS, but at the same time, you know, I didn't think they were necessarily amazingly cheap companies either. So I don't know. maybe I could do a quick one for them and throw them on the back page for the dashboard. I wouldn't have to do a full video for them, but that was one of the things that we were as I was saying, is like there wasn't as many commenters in the earlier part of the chat. One of the things I was also going to try to use this live for was to try to gather more ticker ideas for what video should I do next, which we got some ideas for, but still trying to work through ideas for that. Ideas I have in mind for the next video I might do. I don't know. I'm looking in particular on the ones that I kind of already have on the dashboard, just haven't put full valuations for them. I'm somewhat still interested maybe in doing a valuation for ICL. It came up closer to its fair value, but either way, I'm still very interested in the agricultural input space. I just definitely see that as a huge kind of worrying point, a flashpoint in the commodity space in general. But then there's also the energy companies that we kind of talked about. Baytex is one that I'm very interested in. Although maybe I will take a closer look at Petrobras. Maybe do a basic valuation of that, perhaps if its corollaries with oil look pretty decent. But then there's other companies as well. Like I said, there's certain types of companies that are easier to value relative to others. Like retail in particular generally tends to be a little bit more easier to make what I think is more robust models. So things like Ulta actually do appeal to me, even if they're a little bit out of range in terms of valuation. It could be useful to get a more full model for it because of the fact that all it takes is 25% cut for it to come back down to value. UPBD. Let's look at that. Unbound, Upbound. I don't think I've ever heard of this one. Omni-channel, our favorite word. Love that word. Such a great word. Omni-channel platform company leases household durable goods to customers on a lease-to-own basis in the United States, Puerto Rico, and Mexico. Operates in 4 segments. They're the owners of Rent-A-Center? Okay. Okay. Yeah. I'm not sure how much I like that business model. I mean, maybe it sounds to me like something that would be kind of a little janky to be involved in, but I don't know. Maybe if I look closely at, maybe they have built a really good way to protect themselves against poor credit. I don't know. I'd have to look at that. I don't know too much about their business model exactly, but facilitates consumer transactions across a range of store-based virtual channels, offers furniture comprising mattresses, tires, consumer electronics, appliances, tools, handbags, computers, smartphones, and accessories. I would also worry maybe about potential e-commerce getting into their space there. Although if they've managed to build their presence up in the right way, they might be able to withstand that. I don't know. But interesting company. Let me take a look at some of their numbers here. You're saying you're getting pretty high numbers on your model. The last 10 years on average trading at about a PE of 12 or an EV to EBIT around 10. They're trading now at around 10. So maybe cheap on PE basis, but maybe fair value on EV to EBIT basis. Hard to say. Also kind of spike up periods you could argue about, but do they have a dividend? They do have a dividend. Pretty large dividend, seems like. It's their estimates actually first. A little bit of decline this year and then back to relatively typical growth afterwards. Looks like they had a little bit of some volatility in their revenues here. But I'd be kind of curious to see like what kind of cycle their revenues go through relative to like the economic cycle. Like I said, I'm curious to see like what type of situation they have with their customers, because like I would kind of look at this as similar to like a buy now like pay system in terms of like a payment processor, right? It's like it's buy now pay later one way or the other, right? So it's like I'd be curious to see like how good they set up their margins and their capital to protect them against the bad credit of some of their customers. I think because I got easy PW, I didn't choose this one. Yeah, I was definitely thinking about this in comparison to that one for sure. which I'm still sort of curious enough to look at some point maybe here. Even though the returns were better in my model, I felt like pawn was slightly less dire than renting tires to own. That's a sad world. Yeah, no, definitely. And I agree. I agree. It's like they're similar models because it's like this, uh kind of like back end of the economy paying for systems type offers, but it's a little bit different using a pawn setup versus here's this product, pay us, and then we have to come and collect the products afterwards if they're not being paid for type thing, like a rent-a-center. It's like I feel like this is maybe a little bit higher risk. But yeah, like I said, I don't know. That's kind of my intuitional feeling on it. I haven't looked super close at like what type of structure they have with their customers that would maybe protect them against certain things like that. Their margins are pretty consistent. They're not good margins though, unfortunately. These are pretty low margins, but they're pretty consistent. I mean, EZPW had a lot of things that looked nice about it, but it also had its issues too. But those were more related to its capital structure, so it's a little bit different. Speaking on BNPL, one of the BNPLs just became profitable. You're right. Could be a major threat to this model. Probably wrong clientele, but yeah. Yeah. Wait, which one just became profitable or that you're talking about? Which one in particular are you talking about? What's their liabilities like? Pretty significant liabilities. No, I knew I understood. Yeah, BNPL. I meant like which one? Yeah. It took me a second to realize. I was like BNPL. I was like, what ticker is that? But then once you said it the second time you said BNPLs, yeah, I was like, oh, okay, yeah. Sezzle. I've heard that name, but I've definitely never even looked at them in terms of being a company. But yeah, some interesting companies though. Yeah, I definitely, yeah, I feel like if I was to maybe do a quick valuation of one, I would still, yeah, maybe be looking at EZPW, which I was going to say out of the other companies on this list, ones I'm maybe tempted to maybe take a look at this week in terms of how it fits in with some of the other thematics stuff, which was one of the other things I was saying is one of the things that drives my interest in making a model for a company is how well it fits in with getting views in terms of how good I think the returns are, but also how good and robust do I think I can build a model for it based around a lot of macro and economic factors as well. So I am very interested in maybe still taking a look at Encore again. This one has been on the back burner for a long while, but it fits in with a lot of the electrification themes that we're interested in. EZPW, like I said, that's just kind of an interesting, quirky one I want to maybe take a look at. But then WSM has still been sitting here as well, still sort of interested in that one. And then I do really kind of want to take a look at Hologic. So I might do some basic valuations on some of these ones, and maybe one of those will come maybe the next video. But then I'm also beyond that, there's, as I was saying, also BTE, ICL, Ulta, maybe ones that I kind of maybe would build a full model for as well. So hard to say. CVS, I totally tucked that in my boomers getting older theme. Yeah, see, like that's the thing is like those companies do fit in kind of well with that theme as well. Yeah, like I said, it's just the debt levels and the margins that kind of make me not like them as much, I guess. I don't know if they were super cheap, but you know, I'm actually what was CVS current trend? Was it trading at like a 10 to 11? Was that what it was? I can't remember now. H9. Okay. What was that? Sezzle. Video on JXN would also be nice. Maybe. That's also a more complicated one to build a model for too, to be honest. Like I built a model for FG, and that was a complicated model. It would be a similarly complicated model, but I took a lot of time to build the FG model. That one I worked on for quite some time. Admittedly, this is one of the tricky parts to my process. It's difficult. It's like, look, I have a 2-week process here. I put out a video every 2 weeks. So that means that basically I have to have an idea of what the model is going to be in that 2 weeks, or I have to, there's like, I have starter valuations where I've done some base level work. And then if I take one of these and I build it into a full valuation, that takes a certain amount of time. But if it's not even on this list to begin with, then that means it's going to take twice as much time. And then in terms of the time, the faster I can kind of build up an easy model for it, the faster I can make the video. So it's like one of these things where it's like I sort of need as much time out of the 2 weeks as possible in order to try to have as much time to work on the model as possible. So it's a little bit of a bum rush, basically, every time I finish a video to try to figure out what company I want to do next so that I have as much time as possible working on it. Because that makes the video better the more time I work on it. So it tends to be a little bit of a weird little rush to try to figure that out. GT, yo, how's it going? I don't think I've seen you in the chat for a little while. BOC. School doesn't start for me for about 3 weeks. About halfway through August is when school starts. And we'll see. We'll see. You know, I did a very good job in my last semester of keeping up a pretty good pace. I had a few weeks where I kind of had to take an extra week in between. But I also changed my school scheduling around. So like last semester, I was on campus 3 days a week. In this semester, I'm actually only gonna be on campus 2 days a week, which, you know, I mean, it's the same amount of classes really. So it's like still the same amount of work in terms of like out off of campus at home, homework and stuff. But the point is that's less travel time. So, you know, maybe depending on how things work out, you know, I might theoretically have a little bit more time on my hand. I also do have a day job, which I work only 1 day a week at, which I might just quit when the school starts. I don't know. That's the thing, is like if things get difficult, I would probably look to quit my 1 day a week day job before trying to trim things down on the channel, because I'm trying to build the channel, you know, like I'm trying to turn this channel into income. That's the plan here, is to do that, right? So it's one of those things where well I'm gonna try to keep up the normal pace with the videos, but I might have to slow down depending, because school comes first, but the channel comes second. So as best as I can, the channel will keep going as it is. But I might have had to change things up eventually anyway, because the thing is, once I grow a little bit more, I will eventually have new features open on the channel that will allow me to do different things. Like in particular, once I up my hours viewership a little bit higher, I will have the memberships option open to me. And so once the memberships are open, I'm really going to start trying to push people to join the membership, which will, you know, cost a few bucks a month or whatever. And there will theoretically be features I'll be giving to the membership. And I haven't decided exactly like how I'm going to go about this and like what features I'm going to use or do or what. But like things I've thought about was basically creating a system where people who are part of the membership would basically be part of like a raffle of sorts, where the longer you've been in the membership, the more tickets you have in the raffle. And then this would maybe give you the option to choose which company I do valuations on. And that would maybe only be done like maybe once a month or maybe even once a quarter or something, because I would have to only be so often. But then I could also maybe have members be able to see my videos first. Like you can have videos premiere to members a few days in advance or something like that. So like, I don't know. The point is once I have those features open up, which is supposed to be pretty soon, maybe within a month or two, depending on how fast things move, then I might have been changing my schedule of videos around in accordance with that. So it's hard to say exactly where things would go, but plenty of kind of changes and things coming with the channel as things kind of move and stuff. So GT, I saw you did respond a little bit. Not bad, man. I've been watching my videos after the fact. I'm busy a little bit over here. How things with me? Things are good. Things are good. Things are, you know, moving along. Getting what I think I've been getting better in terms of the quality of my research. I think I've been getting better in terms of the quality of my videos. Everything outside of investing in the channel has been pretty good in my life. So yeah, life's been good. Life's been good. Yeah. It's probably hard to get caught up on all of my content if you're trying to watch all of it. I don't know. Some people watch lots of content and some people watch only so much content. So it's like, yeah, good, nice to hear you're watching. I appreciate the support. But yeah. I'd never watch everything. Yeah. You'd never watch everything. I mean, it's one of those things where, you know, different people watch and different do things differently. I know I've talked about it before. It's like I watch and listen to a lot of YouTube content. And like some people have content slates that are like really huge, and obviously like as I just said, I listen to a lot of YouTube content too, so like a lot of it is I'm just listening, I'm not even watching. But like for content that was a lot like that, you could speed it up if you are willing to do that. Like some people can't stand listening to things sped up, but like I'm the type of person that listens to like 12-hour long podcasts on YouTube at like time and a half speed or something like that. And it's just like in my ear all day long. So and like there literally is like a podcast that I listen to every week that does basically 2 8-hour shows a week. So it's like that's like 16 hours of content, which like I said, I listen to generally at like time and a half. So that's probably closer to more like 10 to 12 hours or something. But yeah, so it's one of those things that's pretty crazy. GT got a job working for the Bank of England. Holy crap, man, that's awesome. Very nice. I didn't know that you were necessarily in the finance or economics space or whatever. I don't know what type of job you have for them. Obviously that could be a wide variety of things. Technically maybe you're not even in economics or finance. I don't know. Maybe it could be marketing or publicity or something. I don't know. There's a million jobs. What you doing? If you don't mind my asking, I'm curious to hear about that. That's fascinating. Jeff, same. I love to play 2K23 and listen to finance stuff. So yeah, it's like, yeah, I'm always listening to something while I'm doing other stuff. It's like one thing in my ear, another thing in front of my eyes type situation, generally always. But yeah, in fact, that podcast in question that I was talking about is on Sundays. So usually like right after I get off my live, I go and start listening to one of those podcasts. It's like a Sunday show. But yeah, so not sure what we're doing this week. Like I said, kind of looking at these options. Those are the ones that are kind of on my mind. I've said it now a couple times basically already, but like those are the ones I've highlighted a few times. Those are the ones that maybe are going to be the next video. I don't know or think that I'm necessarily going to do a Jackson model because it's going to be a very complicated financial company. It's like I'm invested in Jackson. I have my valuation on Jackson, but even as I said when I was talking about it a little bit, it's like it's a little bit of me looking side eye at it and being like, this just looks wrong. Like I don't necessarily have some super high level of confidence with Jackson. I'm still kind of just like working through the numbers a little bit. If I find enough information about it that really makes me feel like I have like a really solid thesis and I can really spell it out to you guys really easily, then maybe I'll make a video on it. Cause like that's kind of what I'm trying to get at with like those 3 factors. It's like, how good is the opportunity, right? How good is the opportunity? How well do I think I can explain the opportunity? And how well do I think you guys will like the opportunity, right? It's like those 3 factors. It's like those things decide how I make videos. So it's like, while Jackson's a good opportunity, I'm not sure that I would be able to necessarily put as good of an explanation for why that valuation works well compared to FG. Like FG, there was some other factors to it related to its business relations and the fact that it was a new company that helped me explain why it's so cheap. I'm having difficulty explaining why Jackson is so cheap. So that's like one example of like why I'm less enthusiastic about maybe making a video for Jackson compared to like FG. So GT, he's on the finance team. Okay, yeah, I thought I remember you saying you were in finance, but I couldn't remember. We produce the reports that go to the governors who then decide what to do with the interest rates. Damn. So my guy GT right here is on the inside. He can put in a you could put in a little push one way or the other. Maybe I'm probably not. Obviously, you have. There's a process, obviously, but But damn, make sure you put in a word with Mr. Powell, or put in a word to the man who puts in a word to Mr. Powell. Speaking of which, obviously, guys, this week we're getting what appears to be a basically 100% chance of another rate hike. According to the market, it basically seems to be a downright guarantee that we're getting a rate hike. The real question seems to be about whether or not there's going to be any more rate hikes thereafter. Obviously, I'm still in the camp that believes that we're going to have more rate hikes. I don't really think that we're there necessarily just yet, but there is some reason to believe that maybe that they'll do another skip. That's totally, I don't think, outside the realm of possibility. And I could be wrong on another rate hike potentiality too. It's possible that they just try to like ride it out where it currently is at. I do think that if you left it where it's currently at, even without this week's rate hike, and just left it there for a very long time, and I mean like a decade, well then you would kill inflation, no matter what. It's really just a question of, you know, the magnitude plus time. It's time and magnitude that decides how the job gets done, not necessarily one or the other. So it's like, it's not that you have to reach some terminal point or it has to be held for a certain length. It's some sort of combination between the two that decides the overall level of the tightening process. Our man GT on the inside says 2 more at least. Okay, so he's kind of in the camp with me. That's basically about what I assume. I had said several months ago, like you can find it in the live videos from many months ago. I had basically made my estimates of where I thought rates needed to go to get the job done, and I said that I thought it needed to get to like 6.25. And I said that prior to the skip though, and my assumption was assuming that they weren't going to do a skip. So based off of that, you could kind of argue maybe even adding one on top of that to a certain extent. But so that basically is kind of in that range. That's basically about what I had said. So I'd point that out. I was like, I basically kind of called the terminal rate like the start of the year, or like February or March or whenever it was when I started talking about that. I actually kind of, I think, nailed it on the head. But we'll see. Yeah, 2 more at least I think is about right. 2 more. 1 more could probably get the job done. It just might be a little more obnoxious to get it done. 3 would also get the job done, but you might be rushing back down. I don't know. It's one of these things where it's like, it's tricky. Let's go to 10. Yeah, I mean, I'm cool. 10%. I mean, let's do it. Why not? Who needs market liquidity, right? We can destroy the market liquidity, right? But yeah, okay, so I guess that's going to be it, I think, for today. We managed to go for a little bit longer than normal today, which is fine, because I think for the last couple of weeks I was going a little bit shorter than normal. So I owed it to you guys. I had to make it up to you guys for a little bit. And nice that we had some of you guys show up here a little bit in the later half. So we had some more things to keep talking about in the later half. And then a few new people showed up to talk in the earlier half. So it was nice to have some discussions with some newer viewers that we haven't chatted with before. Also, GT, yeah, nice to hear from you. Like I said, hadn't seen you for a while. So yeah, good to hear from you. Hearing from regulars, hearing from some old regulars, and hearing from some newbies all today. Very good, very good. So I'll catch you all next week. Like I said, hopefully by next week, I'll have a more solid idea of what the next video is. But obviously, like I said, it's a 2-week process. So I have 2 weeks to figure that out. But yeah, between those like 5 or 6 I mentioned, probably going to maybe be one of those ones. I am still looking very closely at oil in general. I am very tempted at maybe taking a position in Baytex, with regardless of having a full model or not. I am interested maybe in taking a position in Baytex. I haven't done it yet though, but it's something I've been eyeing all of last week. All of last week I was very tempted. I might do it in this week. So I don't know. We'll see about that. Catch you all in the next one.